Okay, welcome back, students who are taking financial accounting, and we're working on the theory videos for chapter 1, which is titled Business Accounting and You, and we are on the 10th video in this series. So I'm not, if you watched the 9th video, then you have a pretty good idea as to where exactly we're at. And so we're going to just jump right into what is actually in the chapter and try to, work through it here. Okay, so as we go along, I'm going to provide, additional information, thoughts that pop into my head, and like I said, a kind of like a translation to what's in the chapter as to what I find works a little bit better, or at least it did for me. Okay, so the accounting equation. All right, get my pen here. All right, this is the accounting equation. Assets is equal to liabilities and stockholders' equity. Now, because we're dealing with financial accounting, it's called stockholders' equity because there's shares being held, common shares of stock being held in the company, a corporation. If it was just a sole proprietorship, all right, there wouldn't be any stockholders' equity. Okay, it wouldn't be, there is no common stock in a sole proprietorship, so it would just be called equity, all right? But throughout the book, this is going to be treated as if the business is incorporated, because when a lot of businesses start out, the vast majority of businesses start out very small, mom and pop, and they are sole proprietorships, meaning the owner owns the business. But as they start to get a little bit larger, they decide to take on, become incorporated and start and become a corporation. And in doing that, they create common stock, and therefore the equity section of the accounting equation is called stockholders' equity. Okay, so so if you just hear stockholders' equity or just equity or owner's equity, all right, owner's equity again is referring to a sole proprietorship. Let me write that down here. Owner's equity. That's pertains to sole proprietor, but equity is the term that's going to be used for that portion of the accounting equation. So assets is equal to liabilities plus owner's equity. Now, the accounting equation shows up on the balance sheet. Okay. All of the asset accounts, liability account, and equity accounts are on the balance sheet. There is what is called an extended accounting equation. And the extended accounting equation is basically assets is equal to liabilities plus equity plus revenues minus expenses. Okay. Now, the reason why this is called an extended accounting equation and you don't see it here is because revenues and expenses show up on the income statement. The balance sheet is, when you create a balance sheet, it shows the financial position of the company from its inception, regardless of how long ago that was. If the business started a week ago, a month ago, a year ago, 10 years ago, 20 years ago, or in the case of like Penn Foster, 125 years ago, okay, what we're looking at is on the balance sheet as of a specific date, the financial position of the company. Okay. Now, that means, like, for example, on day one, your cash account started with 0. But 125 years later, let's say your cash account has in it $45,671.15. Okay, well, that balance in that account reflects all of the transactions for that 125-year period, and that's the balance at this moment in time, right? So everything on the balance sheet is like a running balance, okay? But on the income statement shows the operation of the business, meaning, you know, why are we in business? We're in business to sell something, which is revenues, and we have to pay, expenses, and the difference between the two is our profit or loss. Okay. Well, that profit or loss, since the income statement is for a period of time, which we call an accounting cycle, at the end of each accounting cycle, we actually have to close out those accounts. Closing out means we have to reduce the balances in those general ledger accounts down to zero. Well, if we, since everything has to stay contained in the books, if we, let's say our revenue accounts had, say, $75,000 and our expense accounts had, say, $25,000. Okay, well, we have to reduce that $75,000 down to zero, and we have to reduce those expenses of $25,000 down to zero. Well, where does this all go? Where does that profit of $50,000 go? $50,000 is the difference between these two. Well, where does this $50,000 go? Well, it actually ends up being put into the equity account. Okay, into the equity accounts, depending upon the structure of the business. Okay, if it's a sole proprietorship, all right, it would go into what's called a capital account. If it's a corporation, it ends up in what's called retained earnings instead. And notice the connotations of capital and retained earnings. I mean, if I put money into the business, that's my capital. But if it's a corporation, the profit or loss, this 50,000 is my earnings. Well, I'm retaining those earnings, and that's why it's called retained earnings. Okay, so what we have here is, the extended accounting equation, all right, which is our assets equals our liabilities plus equity plus our revenues less our expenses, right? Now, and again, if you're not, I'm erasing this stuff, pause the video, go back and rewind it, and watch it again, write it down if you have to, and that's the beauty of video. Okay, so our accounting equation is assets is equal to liabilities plus equity. Notice here that in math, when you know two out of three things, you can always find the third thing. Okay, as an example, if I had 2 plus what is equal to 5, well, that's going to be 3. I mean, but if I went and said, just because it's such easy math, but if I went and said $113,987.65 plus what is equal to $784,651.21. Okay, well, because you know 2 out of 3, you're able to find that third thing. Obviously, you just subtract the 113 from the 784 to be able to find that. Well, this works the same with the accounting equation. Okay, assets is equal to liabilities plus equity. And if you know 2 out of the 3, you can always find the third. So we can always, do some little algebraic work here in order to find something that we didn't know. For example, if I had $10,000 in assets and I knew that my equity was, say, 7,000, okay, well, and I don't know what my liabilities are, I can figure out that my liabilities are 3,000 just by manipulating the accounting equation. Okay. The most common example of that is Assets equals liabilities plus equity. Okay. But let's say the company decides to go out of business. Well, or let's say you want to know what the net worth of the business is. Okay. Well, knowing what the net worth of the business is how much equity we have. Or if the business goes out of business, if the company goes out of business, we have to find out how much would be left over for equity. Well, we can manipulate the formula to say assets minus liabilities is equal to our equity. Okay. So if our assets were 10,000 and our liabilities were 3,000, that means our equity would be 7,000. Okay. If the company was going out, that's our net worth in the business. If the company goes out of business, they sell off their assets, they pay off their liabilities, and whatever is left over, goes, back to the people who invested into the business. Okay. So we have the accounting equation, and remember, the accounting equation shows the financial position of the company. Okay, and it's on the balance sheet. And we can manipulate that accounting equation in order to determine, what our liabilities are or our equity is. All right. So, with that said, let's look at just a few more definitions, and we'll move on to another. We'll stop this video and then move on. So, what's the definition of an asset? Well, here it's showing what the business owns, okay, which is true. So an asset is what the business owns. Now, liability and stockholders' equity, the textbook says who provides the money, which is true, because if you, if people are, people are going to be giving you money, and it could come in two forms. I like to call the definition of liabilities what the business owes, O-W-E-S, versus owns, okay? And the equity is what is invested in the business, okay? The investment in the business. So if, it says who provides the money, well, if I take out a loan, yeah, that's money that's coming into the business, but I have to pay that back. That's why I owe it. Okay. And if I have equity, someone invests in the business, that's money that the business is using, right? That eventually gets returned back to the business if it ends up closing, or if it's drawn out of the business. Okay. So the definition of an asset is what a business owns. The definition of liabilities is what a business owes, O-W-E-S, and the definition of equity is what's invested in the business. Now, I had talked about the accounting equation, the extended accounting equation, which included revenues and expenses. Okay. Well, revenues are the sales. Okay. Whatever is being sold during the operation of the business. And expenses are the money that is going out in order to be able to run the business, the operation of the business. Okay, so that's how you look at revenues and expenses. And keeping these are the 5 categories, of accounts. Assets are 1, liabilities are 2, stockholders' equity is 3, revenues are 4, and expenses are 5. Okay, and when we have our general ledger accounts, the general ledger accounts have numbers. Okay, and depending upon the category of what type of account, the category of account, it will begin with one of those numbers. So if I have an asset, let's say my numbering scheme for my ledger accounts are 4 digits, right? 2, 3, 4, 4 digits. So if I have an asset account, that asset account is going to begin with a 1 and 3 other digits. If I have a liability account, it's going to begin with a 2 and 3 other digits. An equity begins with a 3. Revenues will begin with a 4, and expenses will begin with a 5. Now, it doesn't have to be 4 digits. No, it could be 3 digits. Okay. And again, assets would begin with a 1, liabilities with a 2, and so on and so forth. So it all depends upon the business or the account to determine how many numbers are being used for the equity accounts. But if it's an asset, it will be that number, whatever that numbering scheme is, will begin with a 1, and the liabilities will begin with a 2. Okay, equity with 3, revenues 4, and expenses are 5. And knowing the definition of each of these is important because that's going to help you down the road be able to make journal entries when you don't know how to make a journal entry. I mean, a lot of students, and I realize we're getting ahead of ourselves, I'm getting ahead of myself right now. When it comes to making journal entries, they just go back into the book and try to look it up because they've seen, it's like a chicken or an egg, which comes first. Well, in order to teach the concepts, they have to give a journal entry, okay, in order to be able to understand how to make a journal entry. And students will have a tendency to forego the thought process of making the journal entry and just copy it out of the book. Okay. Well, when they come across a situation where they don't know how to make a journal entry and it's not in the book, they're stuck. By remembering, what the definition of an asset is, a liability, equity, revenues, and expenses, okay, that will help you to be able to make more correct journal entries going down the road. Okay, so with that, I'm going to stop here and pick up in the next video. And again, if you didn't understand something, go ahead and rewind and watch the video and, a few more times. And if you still don't understand, contact an instructor. Okay, see you in the next video.